Okay, our global voice is ready with us as always. Lawrence Belanco of CLSA is now joining in. He's, of course, their chief market technician. Lawrence, great to have you with us here on the program. Thank you very much. Lawrence, you believe that we're on the cusp of another turn, a turn lower this time? I mean, if you will explain that, please.
Yeah, absolutely. Unfortunately, we've seen this pretty broad trading range for the Nifty year to date, roughly 15% wide. So we've really traded between 16,000 and 18,000 year to date. And the rally that we've seen off the June lows is now taking us into that resistance zone, which is basically the highs that you made back in March and the highs that you made in January. And in conjunction with that resistance area, we have some of our shorter term indicators flashing buying exhaustion, so that comes from our DMARC indicators. So we do think there's a downside risk for a correction within that range that you've seen year to date.
Lawrence, good morning. So your DMARC 9 signal, right? That's what you referred to, and with the RSI where it is, you believe we are at some kind of a top and maybe reversal like we saw in the previous three tops. But does that mean that the market will make a lower bottom as well, or is this for now just a call on the exhaustion on the upside?
Yeah, so I think we need to be aware that the upside risk isn't attractive here. And even if we just take it to the midpoint of the range, we have greater downside risk being capped at the 18,300 area. And our view for US markets is that we do think we retest the June lows, which does leave the Nifty vulnerable to fall back to that 16,000 area, which is where we've seen the lows develop in June as well as back in March. So there's definitely a risk of falling back to retest the lows. We think that is a likely event basically going forward. And the best case scenario is actually to find support at the midpoint of this range where the 200-day moving average sits, and that's roughly at the 16,800 area.
Okay, so you're saying that there is a risk that the Nifty falls to 16,000 in the near term, but that's not your base case, right?
That's right. Yep. So base case is that we have a 5 to 8% correction, which puts us roughly back in the middle part of the range.
So your base case is there's a 5 to 8% correction. What happens then? Once this medium-term pause or correction is out of the way, do you see a big rally towards the end of the year or not quite? I'm asking for the Nifty particularly.
Yep. So for the Nifty, and assuming our roadmap is correct, that we hold above the 200-day, so we get a higher low within this trading range, we should see a fourth quarter rally that then breaks above the 18,300 area. And we can then see a confirmed breakout and an extension of the longer term uptrend for the Nifty. And we can talk about targets of 20,000 plus. But the key thing is how deep the correction is through this month and into October. And assuming we hold the 200-day, that's where we can have a far more constructive view for the fourth quarter and the start of 2023.
Lawrence, you said your base case is that in the US, indices go back to June lows. That's the base case, right?
Yes. Yes.
Right. I mean, if that were to materialize, you don't think, the extent of the pullback will be pretty similar or maybe even more in many markets?
Yeah, I mean, it's an interesting question, because if you look at the regional markets and the correction from January through to June in the US, Indonesia didn't make new lows. If you look at the Nifty, we've essentially been trapped in a trading range, rather have these distinctive downtrends as you've got in the US in its correction. And Japan's another market which has essentially been range bound all year, despite the new lows that you had from the January highs into the June lows for the US market. So there has been a distinction in the way global markets have traded versus that US setup. I think in absolute terms, we obviously can't get a breakout with weakness in the US markets, but on a relative basis, we can see some of the regional markets fall less than the US. I think that's a key distinction that we can make and have made year to date.
Lawrence, okay, so on the NASDAQ in particular, since you referred to it, how important is this 200-day moving average area? Because that's the lead indicator for a lot of markets. Most of the markets are correlated with what's happening in NASDAQ.
Yeah, but I mean, again, if you look at Nifty, you're above the 200-day. If you look at NASDAQ, you look at S&P, they all failed at the 200-day, right? So again, there is a difference in the way these markets have traded. But back to your question on the NASDAQ, classic bear market rally, failed at the 200-day. And again, we think we go back and at least retest those June lows on the NASDAQ, if you look at some of the unprofitable tech indices, or if you look at the ARC Innovation Fund, they didn't even get back to their 200-day. They've rolled over and actually peaked a week before the NASDAQ peaked last week, so leading the market on the downside again. And again, expecting new lows for the unprofitable tech and the innovation type side of the market.
So coming back to India, Lawrence, you said that there's a downside risk of around 5 to 8%, which is your base case. What do you think could lead it there? Are you looking at banks, IT, Reliance Industries? How are you, gauging the leaders now? Where do you see the weakness coming from?
Well, I think one space that's been a great outperformer where we think we should take some profits is on the auto space. That led the breakout, was one of the key sectors performing since the June lows. So I think on the back of profit taking, you could see the biggest short-term correction there. And then following that, banks have also been extended short-term. So we're talking about the short-term extremes in the move up, but banks can also see a pullback after their recent breakout. The longer-term profile, and we continue to say this, we think the Nifty Banks Index is one of the key longer-term leadership groups, but obviously in the near term, we think the autos and the banks is the resultant of the pullback that we see from these short-term extremes that we're getting.
Got that. Lawrence, two other variables. One is the dollar, the DXY. Do you think it's breaking out? And the other is our oil prices. What's your view there?
Yeah, I'm going to start with oil because it's a clearer setup and more conviction on this. Basically, the correction that you've seen in oil has found pretty good support. And we're talking about the Brent levels in the higher 80s, lower 90s, and we've essentially got a stability in a short-term double bottom pattern forming there. So we do think that oil is now stabilizing in the higher 80s, lower 90s, and the upside rebound is basically back towards the 115 area. That's within the context of a trading range that's developing between the higher 80s
115, 115.
and 120, 115,
Yeah.
Okay.
So, yeah, go ahead.
Go ahead.
No, I was going to finish off with the dollar index. That had corrected back to the 50-day. That's where it's found support. It has rebounded off that, and essentially looking at the continuation of the uptrend developing on DXY. And for rupiah, there's no change in our view. We think that does weaken towards the 82 area.
Okay, the other interesting, I think you tracked this, Lawrence, right? The US bond yield. And that's also sort of reversing, right? Almost back to 3 now. What are the charts indicating here?
Yeah, key points. And this was one of the distinguishing features why we thought the rally was coming to an end is basically bond yields stopped declining on the 1st of August, and equity markets essentially had an extra 10 days of trading higher while bond yields had started to rise again. And that rise in the 10-year yields taken price action back above the 50-day moving average, and looks like we're set to retest the 349 level, which was the highs made through June. So we should see an extension to that. So again, that's another factor why we think equity markets need to pull back and pause here.
You did say that you recommend taking profits in the auto space and in banks back home in India. What about spaces like IT? There's been a big reversal over there as well, but now some of these stocks are coming back into action. What do you do here with the large cap IT names?
Yeah, I think they've started to stabilize really after big declines. That was one of the key drivers to the downside in the sell-off from the January highs. But if you look at some of the large cap names, you've actually started to see some stability and a trading range develop there. So while they pull back, they're likely to pull back within their trading ranges. So you could get some relative outperformance, but they do pull back with the broader market within trading ranges and shorter term trading ranges after the big sell-off that you saw from January in the tech space.
Are there any good places to kind of hide, for the lack of a better word, here in India? Any sectors which are looking relatively stronger?
Well, again, that tech side would be a place you could hide into on a relative basis, that they start to stabilize at this point. Out of the large cap space, that would be the one that I think you could hide in, yes. And if you look at energy, it's really dominated by Reliance. It's another place that it's very much a trading range that you can hide in from a relative perspective because it holds that range.